You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The trading day doesn't start when the opening bell rings. Pros understand that risk never sleeps, and market-moving events happen around the clock. How can you arm yourself with the information you need to understand what's going on across the pond and how it can impact your portfolio? Welcome to the European Market Brief, your go-to source for information on the fast-moving European derivatives markets. Each episode brings you expert insights into the latest market trends, discussions of cutting-edge trading strategies, breakdowns of exciting new products, and analysis of thought-provoking trading activity. The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of Euro Stoxx, VStoxx, DAX, and European rates derivatives like the Bund, Bobble, and Schatz, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com. So join us as we shine a spotlight across the pond and explore the cross-border volatility, regulation, and innovation that makes the marketplace so fascinating. It's time to get the European Market Brief.
All right, everybody, that music means we are back once again. It is time to roll out another episode of the European Market Brief. My name, of course, Mark Longo from the optionsinsider.com, as well as from the network upon which all of you folks have been enjoying of late. Remember, if you're just listening to the European Market Brief, A, we love you, we welcome you. B, make sure you're subscribed to the full network wherever you get your favorite podcast. It's available on just about every platform under the sun. And if you're not, you're really missing out on a lot of great content flowing at you. And of course, speaking of missing out, we'll be coming back later today with some great content, including some early oddities action on this truncated holiday week for all of our pro friends. If you haven't checked that out yet, theoptionsinsider.com/pro, the place to go to learn more about all of that fun as we learn who's joining us on the old European Market Brief today. First, we go out to the hinterlands of Chicago, where we are joined once again by our old pal, the once future and present Dr. VStoxx, a.k.a. Mr. Russell Rhoads, holding court over there at the University of Indiana. Mr. Rhoads, welcome back to the European Market Brief, sir.
As always, thrilled to be here. Nothing better than an episode where I get to criticize how we do things in the academic world. Bet you didn't know that was going to happen, did you?
I look forward to that. We had a taste of that last week talking about that academic conference, but now we shall get even more deep insight into your problems with the world of academia. We'll get there in a second, sir. First, let's welcome on two newcomers yet again to the European Market Brief. First, joining us from Bloomberg Index Products, he is Fateen Sharaby. He is the Index Business Manager over there. Fateen, welcome to the European Market Brief, sir.
Well, thank you so much, Mark. Appreciate you having me on. As you mentioned, I'm a business manager within our Bloomberg Index business, and my focus is really on our index-linked derivatives and some of the related tools and analytics. So very excited to be here.
And really quickly, first timer here, why don't you go ahead and give our audience a quick overview of your background in the space, sir?
Yeah, absolutely. So I've been within Bloomberg Index for about 3 years. Before Bloomberg, I spent about over 10 years at the CME Group. So I led the product development of all of the new listed over-the-counter products and post-trade services at CME. Before that, I actually worked as a financial consultant. And so I've been very close to derivatives for many, many years.
All right, and holding down the Eurex hot seat this week, another newcomer to the program and indeed to the network. He is Davide Masi, the global product lead for credit derivatives over there at Eurex. Davide, welcome to the European Market Brief, to you as well.
Thank you. Thank you very much, Mark, for the opportunity to be here. And as you mentioned, I'm working at Eurex as the credit product lead on the credit derivative side. Within the team, we look after our product suite when it comes to credit index futures and other product related to the credit derivative space.
All right, and same question for you, sir. Give our audience a quick overview of your background in the space, sir.
Not as deep as the one of Fateen, unfortunately, or fortunately for my young age. But I've been at Eurex for 7 years now. Before that, I had 1 year at UniCredit looking at the support on the derivative trading team. And within Eurex, I've always been working within the product development team. So looking at product derivatives within the fixed income space across both linear products, so Delta One, and options, trying to find new innovative products and solutions to offer to our clients.
All right, with the team assembled, listeners, it is time to begin our continental conversation.
It's time to catch up with the thought leaders who are shaping the European derivatives markets. It's time to have Continental Conversations.
All right, everybody, welcome to the Continental Conversations, the portion of the program where we dive deeper into a topic. Today, we're going down a very specific rabbit hole, an interesting one there, reminiscent to something we talked about earlier on the show. You'll see what I mean in a little bit, listeners. What are we talking about today? We're talking about credit index futures. Yes, an interesting area of the space, and again, not one that we've really mined in the past, so I'm looking forward to it. But before we really go deep, let's start with the basics, Davide. Let's give our listeners a little bit of the lay of the land. As they're listening to this, they might be saying, what the heck are credit index futures? So I will put that to you, Davide. What the heck are credit index futures? What are we talking about?
Oh dear, what a great responsibility you're giving me now. Well, surprisingly or unsurprisingly, credit index futures are just index futures. They are financial index futures on corporate bond indices. Here is the twist. So what are we talking about? We're talking about cash-settled index futures that reference corporate bond indices, or in the case of the US dollar emerging market sovereign bond index futures, they reference sovereign bond indices. So generally, what we're talking about is nothing dissimilar to a Euro Stoxx 50 futures or an MSCI futures. Credit index futures are essentially just index futures, cash settled, referencing a corporate bond index expiring on the third Friday of each quarterly maturity month, and essentially giving investors the opportunity to get leveraged exposure to the return of the corporate bond market, being that on the Euro side for Euro credit index futures, or on the US dollar side for US dollar credit index futures.
That's a key distinction there, the corporate bond world. If you're listening to this saying, wait a minute, you guys already talked about rates. We did. We had an old episode back in June, episode 4, entitled European Rates. So if you want to dive into the shots and the bobble, all that fun, that is the episode for you. But again, those are the government rates contracts. We're talking something a little bit different here. We're talking the corporate side. So Davide, let's get into some of the offerings here. If I want to trade these things over there at Eurex, what do we have available?
So that is very interesting. We started with the Euro Credit Index Futures product suite. Again, futures on corporate bond indices. This means that differently from the rates futures that you pointed out just earlier, Mark, with credit index futures, you're not getting access, you're not getting exposure to a bond that is physically settled, that is deliverable. you're getting exposure to a index of corporate bonds that is cash settled. So Euro Credit Index futures, what we have here is futures on the Euro Investment Grade Index offered by Bloomberg and on the Euro High Yield Index offered by Bloomberg. We also cover the US dollar credit market, so US dollar investment grade and US dollar high yield index futures, also on Bloomberg indices, as well as a global product suite covering the US dollar emerging market sovereign bond index. So in this case, credit, but applied as a credit spread of the emerging market sovereign debt over the US treasuries, and sterling corporate index future. So back again into the corporate world, but referencing the sterling denominated market, the British sterling denominated markets. We covered these 6 products at Eurex. We have started the product suite back in the end of 2021 with Euro Investment Grade, and little by little, driven by client demands and by increased trading activity, we covered the full segment of this 6 product.
Well, you mentioned a lot of Bloomberg products. If only we had someone from Bloomberg on the show today to kind of go deeper into, oh, wait, I think we do. Fateen, that is your cue, sir. Let's go a little bit deeper into these products. Davide kind of gave us an overview of what is available, but our audience likes when we get into the weeds a little bit. So let's do that now. Let's dive into some of these indexes, some of these products, a little bit more detail, the construction, and maybe what sets them apart a little bit, sir.
Yeah, absolutely. Thank you, Mark. So I think, I think many of your listeners would know that the Bloomberg kind of fixed income index suite, really amongst the most widely used benchmarks for global bond markets. And I think they've really served as the foundation for a lot of the growing suite of tradable credit products that we see, namely ETFs. That market has really grown rapidly in the last 10 or so years, where we, on the Bloomberg side, see about $1 trillion in US dollar assets benchmarked, ETF benchmarked to our indices. And now, recently, credit index futures. For the credit index futures, as Davide mentioned, these products are linked to our corporate bond indices. So that is a huge segment of the fixed income market. We use, and this is standard for our methodology, we use a rules-based approach, okay? And that's important for predictability, the ability to replicate the benchmark. And these are also market value weighted and rebalanced monthly. So that means, they're constantly adapting to reflect the most up-to-date investable bond universe. When we think about the bond eligibility for these indices, we use kind of objective criteria. So, minimum issue sizes that can vary depending on the market, 300 million, 100 million. We're looking at ratings. We're looking at rating screens. We want to make sure that all of the bonds are tradable because that's very important to what I mentioned, the ability for the investors to replicate these benchmarks. And now I think one part that's very important for futures, at each rebalance, so I said we have monthly rebalancing. The coupons and the principal payments are reinvested. And so the total return performance, it captures the true economic experience of holding the bonds in the index. And that includes the income that would be earned along the way. So you're essentially replicating that exposure as if you held that basket of bonds, which I think is important. Because the futures that reference these indices, they have to be anchored in reality. They need to reflect the portfolios of those investment managers and the returns, not some theoretical basket of 100 or 125 equally weighted names that we see with some of the other products. So they're more representative of the market, the corporate bond market, a better tool for hedging. And as Davide mentioned, much of the volume that you see is in the European, the emerging market contract.
That's a good point about the total return, because you're right. Sometimes we don't include those in the products, and you're right. They're not exactly representative of what we're seeing out there in the market. Speaking of what we're seeing out there in the markets, these are, I think, to put it mildly, as we're recording this, somewhat tumultuous times once again in the markets. Not quite getting back to mid-April wild times, but reminiscent of those times. Massive swings in the indices. We're seeing volume records and a lot of products in the options market these days. A lot of vol percolating back on the screen, then coming back off again. One area on the network we haven't really had a chance to sink our teeth into in these tumultuous markets is the credit side. So let's get there now. Davide, we'll start with you, sir. Obviously, when you're not talking to guys like me, you're out there keeping your eye on these products day to day. What kind of interesting developments have you noticed in these recent weeks and months as these markets have gotten a little bit, shall we say, interesting?
For sure, that's a very interesting question. And there has been quite some interesting trades and activity being put on the credit index futures lately, especially in on the European credit products. One of the few highlights that I would like to give is the divergence that we are currently experiencing and the volatility around the spreads between Euro investment grade and Euro high yield market. In particular, what we have been seeing since the end of September / beginning of October, / beginning of November, is the fact that quality in the corporate bond market has been rewarded by investors over the past few weeks. This has essentially resulted in a relatively stable Euro investment grade credit spreads and in quite volatile instead Euro high yield credit spreads that were subject to a few spread swings, a few widening and narrowing movements, essentially due to the fact that lower quality Euro high yield bonds have been subject to higher volatility. And I'm not talking about, let's say, the bonds and the firms that were more sound in financials and fundamentals in the Euro high yield space, like the ones that are rated in the double B or single B space, but the one that are, let's say, a little bit more in a distressed market conditions, the one around the triple C's and C's. These have seen quite some volatility in the credit spreads. They've been subject to quite some distress. And as a result, because obviously these bonds and these issuers are part of the Euro high yield index futures and of the Euro high yield index in general, they have been affecting the performance of the Euro high yield index and of the Euro high yield index futures. And as a result, we've seen quite a few market participants starting to take advantage of this volatility of the high yield spread relative to the Euro investment grade spread and putting compression trades or decompression trades depending on whether they were seeing high yield spreads compressing towards the level of investment grade spreads or the other way around, high yield spread decompressing towards the investment grade spreads. And this has been a trend and a move that October and beginning of November have seen quite a lot in the Euro credit markets. So this is some of the trades that we have seen in the futures.
Interesting. You know, we've been talking about yield volatility for a while now on our This Week in Futures option show. Here is a literal example of that playing out across the pond, listeners. Let's go over to Bloomberg land now. Fateen, same question for you, sir. You're obviously watching these markets day in, day out. Do you agree with what Davide was saying, or do you think he's full of nonsense? And then B, any other trades or developments that's catching your eye out there in the market, sir?
I would absolutely agree with Davide, of course.
No, I was trying to gin up a little bit of heat on the show here.
There you go. We'll get there. I would say, look, over the last year, when we look at these corporate bond indices, you have steady mid-single-digit, low double-digit returns, right? It depends on which market we're talking about. But I think it stands out against the volatility that we've seen in equities. So if you look at the European investment grade corporate index, that has delivered about a total return about 3% year to date. The high yield, maybe it's 4.5%. We've seen obviously spreads tighten. And then the emerging market US dollar sovereign index, that's really led the way. There you have over a 12% total return year to date. Largely that's due to a rebound in the frontier markets. And so while you see equities have been kind of swinging with rate expectations and many other macro influences, credit has been that kind of consistent income driven performer. And I think that stability is a big reason why we see this interest, from institutional and retail shops for the credit index futures. And all of this is, it's a function of the methodology. How we construct these indices? As I mentioned, depending on the index that you cover, you're talking about hundreds or thousands of members that underlie the index. So it's just more representative, a better measure of these markets. The duration is obviously going to be different depending on which market we're looking at. I mean, if you look at the high yield emerging market, you're talking about 200, 250 plus basis points in the option adjusted spread. So that's meaningful. But I think from a performance perspective, it's done quite well and performed, it's a constant yield generator when you compare it to other markets.
All right, Mr. Rhoads, sir, you're busy over there day on day when you're not talking to me, corrupting young minds of the future over there at Indiana University. First off, let's start. In general, I'm curious, what is your level of engagement with the credit derivatives arena? Is this a hot topic at U of I? Are the kids clamoring for this in the classes? Do you spend a lot of time in this area? And maybe personally, is this an area of interest to you? And then B, what are your thoughts in general on, as I was mentioning just now, these tumultuous markets? What are your thoughts on what we're seeing developing on that side of the space, sir?
Sure. All right. You know better than asking me three questions at once. So I had to scribble that.
Teed you up.
As far as school goes, there's nothing out there about listed credit derivatives that you can really use in the classroom. So I do use the Bloomberg for it. One of the classes that I teach is half equity investment and then half fixed income portfolio management. And we do an awful lot in that fixed income class where we'll have a slew of corporate bonds, and then the book has us hedge them using treasuries. And we got to do all this conversion, and then we talk about the weaknesses there. So I've brought these up. We do now, admittedly, I'm in the States, so I brought up the ones that are over here in the States. But I do talk about, how they're a much quicker way to go about rebalancing your portfolio, and probably a better, especially if you're managing toward an index, a much better way to hedge yourself. You'd be much better off using the high yield index to match yourself up if that's the area that you're focused in on. Also, just you asked me within school, so I do try to bring them up. I do talk about ETFs at this point as well, that it's easy. You don't even have to, because inevitably I'll get questions. Well, how can I trade fixed income instruments, et cetera? My broker doesn't allow me to do those sorts of things. I'm like, man, there are ETFs out there that allow you to do these things, and they're futures as well. So you don't have to be like the bond daddies screaming on the phone to trade these things. From a personal standpoint, I like using the credit derivative markets almost as a complementary risk indicator to VStocks. You can really, and one of the things that and this is pretty accurate, back in the day when Tesla had, it was questionable if they were going to continue to be around, you could
So every day basically is what you're saying?
Well, no, I'm talking about like if they were darn close to running out of cash.
You, yes.
We're talking about a decade or so ago. They had convertibles out. And I was trading Tesla options, and I was day trading them basically. And you could see the credit default, or you could see the convertibles start to move before the stock did. Sometimes, if you're trading, the Euro Stoxx 50 or one of those other indexes, a risk indicator of your market is these indexes. And sometimes I think they're better to get exposure to different capitalizations than the equity ones as well. I wouldn't say that if the equity guy from Eurex was on, but I can say that with the credit guy on from Eurex. But in all seriousness, I think they're great complements. They're great risk indicators. We talk about credit spreads as an indication of, are we in a risk on or risk off market? These indexes by themselves, relative to each other and relative to your I honestly, now I'm just going to embarrass myself. I don't know what the best government bond index would be in Europe to compare them to. I'll defer to the other two guys on that. But I know how I would do that in the United States. And just getting an indication, how are people feeling about the corporate/equity world going into 2026? You can use these indexes to get an idea behind that.
Yeah, you and I have talked before many times on our vol show and others about credits and rates vol and how there aren't as many good indicators for those that are readily available as there are in the equity world. We could have a whole show about that and what's available in Europe as well. But that's a conversation for another day. But an interesting indicator nonetheless. But Davide, Russell kind of led me to my next point, which is, again, the lens through which a lot of our listeners prefer to engage with a lot of futures-oriented markets. It's just easier for a lot of them to add them in a securities account through that wrapper of an ETF or an ETP. Russell mentioned his students are kind of intrigued by that vector as well. So let's go down that road a little bit for our listeners who are listening to this right now and saying, these are interesting, but I'm not sure if I can, or maybe I need a starter point to get engaged with these markets and these indices. Are there some ETFs available? More importantly, looking at the interrelationship, the interaction between the ETF side of the space and the futures. How do these all work together or maybe not work together, sir?
Yeah, absolutely. Actually, credit index futures, you could say that one of the most similar instruments to these are fixed income ETFs. On the European side, there are no corresponding ETFs available to US investors to invest, for example, in Euro corporate bonds. But if we look at the US dollar credit market, then definitely there are ETFs that are tracking the same indices where we have credit index futures product as futures on these underlying indices. The similarities between the two products are such that our liquidity providers that are streaming pricing on the order book and facilitating institutional sized transactions for our institutional clients are using these fixed income ETFs as an hedging product to their book, to the exposure and to the risk that they provide to our institutional sized clients. So they are very interesting product to compare with ETFs. I would say that the main difference is the fact that on the one hand, ETFs usually pay a dividend, whilst credit index futures, they don't pay a dividend. They're futures on total return indices. Therefore, as Fateen was mentioning in the beginning, all the performance, all the coupons that these bonds within the index would generate on a monthly basis, instead of being paid out via a coupon on the ETF side, they are accumulated every day and they keep accruing as the value of the index increases thanks to the performance of the coupon investment. And the other important factor is that, as with every future, they expire every 3 months, whilst ETFs, obviously, they are a continuously held product that has a life of its own and continues until the lists they are delisted, or God forbid, any of the issuers decides to pull the plug on the ETFs. This is one of the main differences. The other main difference that I wanted to point out is the fact that credit index futures, they are leveraged products. So if you compare them with ETFs, you don't have to put down the overall cash that is needed in order to purchase an ETF. Instead, credit index futures, being an unfunded product, require only the initial margin to be put down. On the other hand, this also implies that whenever you take exposure to the credit index futures and to these indices via credit index futures, because you're getting a leveraged exposure, you're also facing a implied financing cost of your transaction. That is essentially what is the corresponding transactions that you would do if you were to take a physical exposure on the ETFs. We're doing it via the futures, means that you don't have all the cash to buy the whatever million exposure in future contracts that you want to take. You're putting down just the initial margin on it. Therefore, you're implicitly borrowing money to get exposure to that.
Yeah, so greater capital efficiency, as is the way with the futures market. Total return all wrapped up together. So if you want it all in one neat little package, then maybe the futures are for you. If you prefer securities account and maybe getting the cash paid to you, you can do with it what you want, then maybe the ETFs are your preferred wrapper out. I think also people listening to this a lot of times think of them as distinct complexes, but you're right, Davide, there's a lot of interrelation between the two. If you're just trading the ETFs, at the end of the day, that flow is aggregating in the futures and vice versa. These markets are hedging and arbing each other all the time. So even if you're only trading one, it definitely is worthwhile, I should say, paying attention to the other. Fateen, same question for you. What are your thoughts on the ETF complex? And also, we had a listener question just pop up in our chat. I usually would save these for the red phone segment, but it is germane to what we're talking about right now. This comes from Option Guy. He wants to know, can the hosts mention or recommend any ETFs for listeners who are looking to participate in these markets? So they're listening, they're intrigued, they want to know more. If there are any particular tickers you could call out for folks they should keep an eye on, by all means, have at it. Fateen, we will start with you, sir.
Yeah, sure. I mean, look, I would say simply the way I view this is credit futures and ETFs, they're not competitors, they're complements. Okay. I think the ETF liquidity that you see, whether it's in Europe or these emerging markets or US dollar, that's one of the reasons why this futures market is growing as fast as it is. The market makers, they're using the ETFs to be able to hedge or offset the risk that they provide, the liquidity that they provide in futures. A good example of that is the Euro corporate future, that tracks nearly the same benchmark as some of the European big ETFs where you have like billions in assets. You're seeing steady inflows. On the emerging market side, there's been State Street has an ETF that switched its benchmark actually to mirror the emerging market US dollar sovereign index. And so that's the same one that is used for the Eurex credit future. And that's kind of helped boost liquidity. Now you see AUM in that ETF over 200 and something million. So that is the futures and ETF, they're just different tools. There's a lot of different trading tools that are out there. So it just gives you another one. And I think this is, what I always say is it's part of a bigger story. You look at the global fixed income market, it's massive, bigger than equities, 150 trillion. But the bond ETFs, it's a small fraction of that, right? It's about 3 trillion of that. And so there's a lot of room to grow, particularly in Europe, where you see fixed ETFs growing at a pretty steady pace. So I think as the ETF usage expands in fixed income, there's an absolute need for derivatives in this space. You need it for hedging and rebalancing and spreads. And that's why we see, and Davide and his team see, a broad range of clients that are utilizing the futures, right? It's investment managers, insurance companies, it's pensions, systematic hedge funds, et cetera. So I would say they're very much complementary tools.
All right. So interesting question. Before we roll on really quickly, Davide, if you have any specific tickers that you watch on a day-to-day basis that you think maybe some of our listeners can use as a good entry point to watch this space, by all means, have at it. Mr. Rhoads, if you want to tag team with any as well, have at it.
Yeah, absolutely. On the credit index futures front, if we look at the European segment, unfortunately for US investors, there are no tickers available in the ETF market through which to access the European credit market. So I can only provide the tickers for the credit index futures offered by Eurex. These are LXYA for the Euro investment grade, namely Lima, X-ray, Yankee, Alpha. And for the Euro high yield, that would be AHWA. So Alpha, Hotel, Water, Alpha. For the US market, we have, as mentioned, ETFs that are tracking the same indices as our corporate bond index futures on the US market. And the ETF tickers are JNK, US for the US dollar high yield, and SPBO for the US dollar investment grade. Whilst for the credit index futures, the tickers corresponding to that are BBLA, so as in Bloomberg, BBLA for the US dollar high yield, and BBEA, so Bravo, Bravo, Echo, Alpha for the US dollar investment grade.
I love it when our listeners hijack the show, but at the end of the day, it's all about you folks, listeners. So great question. I forgot. Option Guy. Great question there, sir. All right, let's keep rolling then. Davide, we'll stay with you for a second here because, like we mentioned earlier, it's been an interesting time to watch this space. As you kind of pointed out earlier, we're seeing growing interest in this space from a variety of audiences. So obviously, the institutional side, the trading market maker side, growing retail audience as well. From your perspective over there at Eurex, what do you think is driving this latest wave of interest, specifically in this arena, the credit derivatives arena, sir?
So historically speaking, what we have seen is that the interest initially in these products was driven by, first of all, institutional clients, so our asset managers on the European front wanted to have a product in the European credit market that they could use in order to hedge their exposure, and that could be different to the exposure that they would get, for example, with credit default swap indices. That was back in 2021, in the end of 2021, when we launched our Euro investment grade index futures. The timing of that product launch was literally just perfect. Not only because we have had a decade of technological advancement and innovation, as well as evolution of the market structure within the fixed income space. Fixed income ETFs are one example of those. Portfolio trading is another one. In general, electronification of trading within the corporate bond market was just making step by step into the future. So not only we had that, we also had supportive liquidity providers that were able to embrace these technological advancement and therefore price credit index futures relying on indices that are made of 1,000 live ticking bonds and make prices on those. But we also had the start, or rather the return, of volatility post-COVID. Beginning of 2022, especially in Europe, was a year where we started to see inflation resurfacing. Eventually, we saw the volatility spiking with the culmination of the Russian invasion of Ukraine. And that has led to a crash in general of the corporate bond market, with credit spreads widening, with rates as well selling off. And that increased the need of our buy-side clients to hedge corporate bond portfolios. And what better product than a credit index futures? So this was literally the first use case for the product. Hedging corporate bond market, hedging portfolios and protecting portfolios from losing values by credit spreads widening. Use cases have evolved since then. Now, obviously, the corporate bond market has gone through different phases. It's rallied, it's crashed again. Spreads have widened, spreads have narrowed. So at the moment, we are experiencing a wide range of use cases, from corporate bond portfolios hedging to implementing tactical asset allocations, either being overweight single portions of a portfolio by US dollar credit index futures and underweight Euro credit index futures, overweight US dollar emerging market versus underweight Euro high yield, you name it. The combinations that are possible on that space are almost limitless. But we're also seeing, as mentioned in the beginning, some relative value trades, taking advantage of the different moves between Euro investment grade and US dollar investment grade, one example, Euro high yield, Euro investment grade, another example. Those are also other use cases that we've seen our investors putting through in their portfolio. Not only that, but some hedge funds with obviously much strong connections with markets, not only in the listed future side, but also on the OTC side, are also able to put relative value trades that combine exposure from credit index futures to fixed income ETFs to trade the basis, the funding basis between the two products, or credit index futures versus credit default swap indices to trade the cash CDS basis and to put a view on whether that a difference in credit returns would widen or narrow, and in general to express other views, for example, between credit index futures and total return swaps. That's another trade that we have seen on.
All right, Mr. Rhoads, sir, a lot going on in this space. Davide just brought up a lot. He also brought up the point sometimes it's nice in the product world to have good timing. good timing can benefit all at the end of the day. Mr. Rhoads, sir, what are your thoughts on everything Davide just laid down, in particular some of these, shall we call them the relative value trades, sir?
Okay. Well, one of the things I do at Kelley is I have open office hours for all of my former and current students. And we talk about, and I got a question that relates to relative value trades a couple of weeks ago, because in the classroom we talk about, trying to pick up a little extra yield, et cetera, but being cautious about whether or not the bonds that you're trying to pick up the extra yield from are priced that way for a reason. And then I'll talk about, maybe you short one bond to go long the other. Well, honestly, I've never shorted a bond, so I don't really know how to structurally do that. But I do talk about using the credit futures to take for the short side of a trade like that, where you try to find some of the undervalued bonds within and pick up a little bit of extra yield. But one way to go about hedging yourself would be through the futures. So it's almost like a spread trade. But the short bond side, which shorting bonds I think is structurally difficult, can be done through the futures.
I like it. Fateen, same question for you, sir. Looking at the drivers of all this action and indeed this interest. I mean, obviously, even our live chat is chiming in, so they're clearly engaged with these markets now as well. What are your thoughts on what's driving this engagement right now, sir?
Yeah, absolutely. And I would just on Russell's point there, one of the examples that we give for the product is, let's say you have an influx of cash, 50 million on a Friday afternoon, and you want to put that to work, right? So you don't want to go uninvested over the weekend. It's much easier to be able to trade the credit future than have to source, however many number of bonds to do a portfolio trade. And then obviously pricing is going to, it's going to be more expensive. So I think that's just one of the key use cases. Davide covered many, but the ability to quickly get exposure to ensure that you're invested, over a weekend. When it comes to that, what's really driven this market and a catalyst for adoption, I think timing is a big thing, right? We can't underlook that. Sometimes, it's just the right time. All of the pieces of the ecosystem are coming together. Davide mentioned the electronification of execution. That's a theme. These markets are becoming more electronic. That begets more transparency, and then it begets more real-time pricing. So one of the things that we've done at Bloomberg is I think many are familiar with BVAL, but now we have intraday BVAL or iBVAL. So this is, the real-time pricing of bonds every, 1 to 15 seconds, depending on the market, so that you have a good idea of where the bond sits, throughout the day. We offer it for over 50,000 bonds. We're going to increase it to about 100,000 come next year. Much of what the underlying indices for these credit futures are already covered by iBVAL. So I think that's a huge step from the end of day marks of the past. So real-time pricing, that gives you, that helps enable the growth of the futures. I think the other thing we're doing that is specific to the index, and this really speaks to the infrastructure supporting this product, is we're taking those real-time bond prices and we're actually creating real-time indices. So we have what we call tradable trackers, and these are liquid representations of the big parent index, okay? And we can have that index tick, every 1 to 15 seconds. So it gives a good indication of where the index level is. And then what you do from there is you build real-time analytics on top of it. So we have our fair value monitor, where many of our existing futures clients are determining, whether the contract is trading rich or cheap versus the benchmark. This is something that has been there for many, many years in equities, and we've established it now for these credit index futures. And then we have a slew of enhancements that we're going to bring to market to be able to offer real-time risk metrics for credit futures. So I think it's timing, it's obviously electronification, it's the infrastructure. All of these things come together, the entire ecosystem to enable the growth of the credit futures.
Well, you mentioned electronification. That's a key trend in a lot of markets. It's also been driving a lot of the retail uptick and retail adoption of a lot of these products. For them, that just provides easier access, easier monitoring for them. We obviously have a lot of retail traders listening to this show, listening right now. So clearly this is an area of growth for this space. Davide, we'll start with you as one of our two product guys here on the show today. What are your thoughts in general on, I mean, this has always been a space, you know, credit derivatives. It's been mostly linked to large institutions, but clearly, as we can see even today, there is a growing level of retail interest in this space. So from that lens, from that perspective, the retail perspective, how can the retail folks come and engage with these products? Are they available on a large number of retail platforms? What can they do?
Well, credit index futures, the one listed at Eurex, are available on a number of retail trading platforms. It is possible to get exposure to these products, and we have had retail clients taking exposure on a number of our credit index futures, from the US dollar credit to the euro credit, as well as the US dollar emerging market. Our credit index futures, especially US dollar emerging market and US dollar credit, as well as euro high yield, they are retail size. They're not extremely sizable in terms of contract size, and the low amount of initial margins that has to be charged, that has to be paid to the clearinghouse or to the retail brokers that offer this access is relatively cheap compared to the full amount of notional you get exposure to. I would say on the retail use cases, credit index futures offer leverage returns on the corporate bond market. Corporate bonds are inherently lower volatility products compared to equity. Therefore, they can be a great instrument to add as a diversifier in one's portfolio. Obviously, as you mentioned as well, timing has to be critical because corporate bond markets are subject from time to time to widening of credit spreads that significantly affect prices of corporate bonds. So the timing of the trade is essential. These products, though, being total return indices, provide not only exposure to the price moves of the bond, but also of the total return of the bond, which means that you have a steady income flowing as an index performance into the product. Being leveraged, they are subject to a financing rate. So if you're long, you're receiving total return of the index, but you're paying implied financing, which usually is very close to the risk-free rate. In the US dollar market is the SOFR rate. In the euro market is the Ester rate. And these products, on the other hand, if you are short, you're obviously paying total return on these indices. This means that you are literally delivering the total return of the indices to the long holders of the position, but you are receiving implied financing rate. Therefore, you are receiving SOFR if you're in the United States, if you're trading US dollar credit, or Ester if you're trading euro credit. So there are these aspects to consider when looking at credit index futures from a retail perspective. They are leveraged products, therefore your returns can be enhanced, your losses as well can be amplified, and most importantly, they are total return products, so you get access to the total return of the indices, but being futures and being leveraged, you are also having an implied financing rate that is playing a role in your profits and loss.
All right, I'm glad to hear there's a lot of available products out there, different sizes as well. Our audience loves everything small and bite-sized on the notional side is hot these days. But Fateen, another way you could play on the product side is, of course, duration. I know you folks have been doing that quite a bit over there at Bloomberg and cooking up a lot of interesting other stuff that allows people to engage with this side of the market in a few maybe interesting and different ways. Why don't you lay those down for our listeners, sir?
Yeah, absolutely. So I think the theme is just a deeper integration of derivatives into index construction. Of course, here we're talking about fixed income, talking about credit, but we see it across asset classes: equity, commodities, crypto, etc. One of the things that we built out and we continue to expand are what we call our rolling futures tracker indices. So these incorporate futures. We cover it again across a variety of asset classes. We'll look to replicate that for these credit futures. And these are essentially indices that measure the performance of maintaining a continuous position in a futures contract as they roll forward. So depending on the contract, you need to define a specific kind of roll mechanism. But they really serve as transparent benchmark for futures performance. And as I mentioned, we'll look to apply it here for the credit futures market. The other thing we offer on the index side that incorporates derivatives and we've had them for some time, but they've just been more meaningful in a higher interest rate environment, or the duration hedged indices. These are benchmarks where we start with our total return index, okay? And we use a strip of treasury futures, calculate the weighting in each of the key rate duration buckets to offset the duration of the total return index. So now you're left with the spread return. And these indices really allow investors to isolate the spread performance, and they can be attractive when we use them in a tradable product wrapper, because they provide an alternative to something like the credit index swap, where those just trade in spread, purely spread. So we see a lot of take up in the duration hedged because it can be used in tandem with, let's say, Boon Bobble shots or treasury futures if you just want to manage the spread return of the portfolio. I mentioned intraday BVAL, that's a big one. We're expanding our analytics. Many of your users may be familiar with Port and FICM and some of these other functions that provide essentially comparative analysis across spread across different products. So we'll continue to expand and support the necessary tools for the credit future. So very, very exciting time.
It is an exciting time. Speaking of time, I'm almost running out of it, which is wild. Time flies when we're talking all things credit derivatives. But before we get to some final thoughts and takeaways, we've talked all the pros, all the cool stuff, all the exciting stuff. We have to talk a little bit of the flip side, the dark side, which is the risks. Davide hit on a few of these already. These are obviously futures products at the end of the day, so there is an inherent leverage and inherent risk in that. But Davide, anything else people should be aware of if they're thinking about engaging with these markets on the risk side, sir?
For sure. Actually, as Fateen outlined, the credit index futures are on corporate bonds and are on total return indices. Therefore, at Eurex, we offer products that are affected by both credit risk and interest rate risks. So if we take, for example, the Euro investment grade index future, if generally interest rates remains unchanged, but credit spreads widen, the price of our credit index futures and obviously of the underlying index will go down. And this is by effect of additional credit risk in the products determined by wider credit spreads. On the other end, if credit spreads remains unchanged, but risk-free interest rate increase, again, we will have the price of our index futures and the price of the underlying indices going down, simply because the interest rate, the risk-free interest rates on these products have gone up, and therefore the yield of these products has increased. And these products are made of bonds. Bonds prices generally decrease whenever yields and interest rate increase. So investors looking at credit index futures needs to be mindful that both credit risk and interest rate risk is embedded in these products, and that therefore, if they want to isolate credit risk only or take a position only on the credit spread on our credit index futures, they need to be able to manage the duration. They need to be able, for example, in the Euro investment grade space, to trade Boon Bobble and shots as well, in order to offset the interest rate risk within the product. And again, as we mentioned before, we're talking about futures contracts, so risks are related to the fact that these offer leverage returns, and to the fact that margins need to be posted. One additional fact that I would like to point out, and this is a key differentiator, for example, with respect to Boon Bobble and shots, is that credit index futures, they are cash settled indices. So let's say you have a position on, you forget to roll, you're not going to be asked to deliver a bond. You will just settle on the index price that was published by Bloomberg on the last trading day. So there is no risk involved in having to deliver 3,000 bonds or 7,000 bonds that are part
so
of
the proverbial truckload of bonds won't show up on your lawn in the middle of the night and on your lawn. That's good to hear, Davide. All right, well, that time flies, like I said, listeners, when we're talking all things credit derivatives. But before we roll out of here for this episode, let's go around the horn, get everyone's final thoughts, maybe some takeaways, things you should be thinking about as you come away from this episode. Mr. Rhoads, we'll start with you, sir.
Well, at minimum, and I think we did get a question in there about how to maybe monitor these a bit.
Well,
But
if you want,
minimum,
I can squeeze that in really quickly if you want to squeeze the question in.
No, I'll kind of address it.
Okay.
So in my point behind that was, we've been talking about V stocks periodically on other programs here. And my recommendation has always been, even if you're not really thinking about trading V stocks, et cetera, if you're involved in the equity world, you want to know what some of the complementary markets are doing. And at minimum, paying attention to the high yield index and the investment grade index relative to maybe what's going on in government bonds and what's going on in the equity space as well is something that you want to pay attention to. I've talked about V stocks versus other markets on these programs as well, and I think what you have to do is get a feel for what's the typical performance spread over different periods of time, and when have they widened out too much, and when have they when have they indicated calm. So you need a historical perspective if you're going to use them as an indicator. But once you've got a feel for them, I think that's an extra thing if you're trading global equity markets that you want to be taking a look at, because credit risk starts to get priced in a bit more before equity risk, and it can give you a bit of an edge.
Yeah, the question was along the lines, listeners, of how to really monitor these markets. Are there good indicators? Are there good vol indicators? Or is it just as simple as monitoring the index values and the products themselves? And as Russell points out, that's a great starting point for a lot of people. You should be at least adding these to your watch list. You have a sense of what's going on, not just in U.S. credit markets, but of course overseas as well. And that might give you some early warning signs, some early indications of some interesting things afoot out there in the market. Fateen, same question for you, sir. As folks are coming away from this episode, what are some of the key points they should take with them, sir?
Yeah, I mean, look, I think Davide hit it on the head in the beginning, which is, these products. This is just like any other index-linked derivative. I would say, don't shy away from it. It is new, but it's about time that the credit space had these futures vehicles that we've never had. When you think about how to leverage them, it's the same as you'd see for equity index derivatives. They're, as I mentioned before, these are complementary to the cash markets, and it provides all investors a way to, or another tool, and there's relative value. There's a lot of things that come off of this. And then we at Bloomberg, we're spending a lot of time to just make sure that we have all the capabilities and we offer the market all the capabilities to be able to trade, pre-trade analysis, post-trade analysis, and we continue to expand that. So I think this market is going to continue to grow, and it's about time.
All right, and Davide, the last final word is yours for takeaways on this market. What should folks come away from this episode thinking about or maybe planning to watch in the future?
Well, first of all, watch this space because it's constantly evolving. Right now, we have 6 products at Eurex offering, let's say, exposure to these 6 global markets, but nothing prevents us from expanding this product suite to other niche products. And obviously, options addressing the comment on how to monitor volatility and early signs are also a product that we are potentially looking at, options on credit index futures, to provide like additional signs and additional ways to manage credit exposure. Additionally, European credit index futures and European markets are difficult market to access from the United States. In this case, you have a way into these markets, either whether you want to provide and express a short view, if you don't trust European issuers, for example, or if you want to provide a long view on the European corporate bond market. This is a efficient and listed, centrally cleared, exchange-traded way to do that.
All right, that music means we have come to the end of another journey through the world of all things credit derivatives. Man, time flies when you're having fun. But before we go, listener, let's go around the horn. If you want to learn more about anything these folks have been laying down, or perhaps you have questions for them specifically, Fateen, we will start with you, sir. Where should folks go if they want to dive a little bit deeper into these Bloomberg products, or also perhaps if they have some questions for you, sir?
Absolutely. So I think what we have within our website, all of our Bloomberg indices, we highlight the derivatives. So you can even just access through our website, Bloomberg indices. For myself, feel free to reach me. If you have a terminal, you can IB me, reach me at my email, fsharaby1@bloomberg.net. Would love to see some incoming and answer any questions that folks have.
There you go. You know where to find them. Bloomberg is the starting point for a lot of the great products you talk about, including, obviously, everything here today. And Mr. Rhoads, if folks are intrigued, they want to engage with you either on the equity vol side, or maybe they want to talk a little credit derivatives vol, where should they go? What should they do?
Well, I think they should just, I'm always on your network.
Just stay tuned.
Yeah, just stay tuned.
You're off this week, though.
I'm always on with you.
No vol views on Friday, so you're off.
I know. No, I don't know what I'm going to do with myself Friday. I guess I'll go buy something. No, my Twitter is the easiest way to find me. It's my full name at RUSSELLRHOADS. Not the weather guy down in Tampa who just hired his son to be there as well. So nepotism.
A little bit of nepotism in the Tampa meteorology market. If you want to discuss that and maybe a little bit of vol as well, give Russell a follow on all the major platforms. 2 S's, 2 L's, RHOADS. All one word smashed together. And Davide, last but not least, if folks are intrigued, they want to check out these products directly for themselves, where should they go? What should they do, sir?
Yeah, for sure. There's a whole bunch of information that we provide on our website by searching for credit index futures. And obviously, I'm available both on Bloomberg. If you search for me, for my name, Davide Masi on Bloomberg, I'll be able to pick up your IBs. You have also my email address, and you can reach out to me, obviously, on my LinkedIn profile as well, Davide Masi. So for my email address, that would be davide.masi@eurex.com. Feel free to pop me an email or send me a message on IB or LinkedIn, and I'll be very happy to pick it up.
There you go, listeners. It's just DAVIDE.MASI if you're looking to hit them up directly on any of those platforms. And, of course, Eurex.com. You know where to go. The wellspring from whence all of this content, all of these episodes we've been doing on all these varieties of products and markets, all of that starts there. Eurex, EUREX.com to learn more. That is going to do it for us on the European market brief today. Not going to do it for us on the network, though. I know it's a short and truncated holiday week. A lot of people are already heading out to a variety of greener or perhaps darker pastures for the holiday here in the U.S., but we're not done yet. We'll be back actually instantaneously for all the pro folks. We'll be doing an early kind of options oddities / pro Q&A session, so join us for that. If you want to check out the pro, you know where to go, theoptionsinsider.com/pro. Back again on Wednesday of this week, of course, with options boot camp, as well as, of course, the futures rundown, and then off for the Thanksgiving Day holiday. No Russell on Friday, no vol views. Then back again really soon with the next episode of the European Market Brief. Stay safe out there, everybody.
The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of Euro Stoxx, VStoxx, DAX, and European rates derivatives like the Bund, Bobble, and Schatz, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.